Hey guys, Curt Graham here, VP of Brokerage at Elite Insurance Partners. I want to make a quick little video here about some news that came out recently about Elevance or Anthem and what a lot of people are referring to as marketing dollar cuts, but really what it means are cuts in commissions. And what I want to do is take a deeper dive and see if this is going to be a negative in just the short term or if this is a longer term trend that we need to be concerned about. And I think it's a little bit of a mixed bag, and so let's just jump right into it. So to start off, Elevance had a great annual enrollment period. They enrolled 238,000 new members. That's 12% growth for them. They were only lagging behind UnitedHealthcare with 380,000 members, which is only 4% because they're just so massive. They're the largest in the space with over 9 million members. Where'd they get all these members from? Well, it looks like it came from Humana and Aetna or CVS. Humana was a big loser in the space. A lot of that was intentional. They actually pulled plans from all over the country and decided to cut back, and I'll show you why that was coming up here shortly. If we jump in, Politico, the Medicare Advantage state of play, what's going on? Well, UnitedHealthcare, they reported their first quarter earnings, which were unusual and unacceptable. According to the company's CEO, the executive pointed to the policy changes from the Biden administration as reasons for the Medicare Advantage business being a poor performer for them. If I come on down here just a little bit more, UnitedHealthcare's shares plunged, and Elevance said, hey, we want to reinsure our investors. Don't worry, we've got our earnings call coming up. Let us do our thing. And they did. They came out. They came out with strong earnings per share growth. It was a good year for them. They saw a 10% year over year growth. They decided to take $880 million and plunge it back into the company, buying 2.2 million shares, a positive thing for a company to do. That means that they feel that the best way that they can use their money is by investing it back into the company. So not a bad thing. I think it's a positive thing. Now, there were some negative things. They faced elevated cost trends that were an 80 basis point year over year increase for them. What was causing some of that? Well, it was navigating the elevated utilization trends in Medicare Advantage, as well as requiring careful management of new volume and target growth across specific populations and geographies. What does that mean? Well, let's jump into one of the factors that are affecting a lot of the plans and see if it affected Elevance. What is that? Star ratings. 2025 Medicare Advantage star ratings and how it affects these plans. One thing I like to note, I think it's kind of comical coming from CMS. They said, hey, there were no major methodological changes for 2025 star ratings. Only minor methodological changes were included in 2025. That might be true for 2025, but I think the trend says something a little bit different. This chart is the distribution of star ratings for MAPD contracts. And in 2022, 74 of 471 contracts had a 5-star rating. That's over 15%. Well, jump ahead one year. 507 total and only 57, just over 10%. 2024, 545 total contracts and only 38. You guys are seeing where I'm going with this. And in 2025, 521 and now only 7. What is it? Just over 1% of all plans qualified. So we go for over 15% of plans qualified for a 5-star rating down to just over 1% of all plans qualified for that. I think there's something going on there. And I don't think it's all the insurance companies just got significantly worse over a 4-year period. This was a major cut to funding. And I'm going to show you what a star rating means in a couple seconds. But let's see if it actually affected Elevance. Remember, there's only 7 plans that had a 5-star rating. So if we jump down to further in the article here, It actually turns out Elevance fared pretty well. Elevance is 2 of the 7. That's pretty darn good. Okay. And a pretty good chunk of their members, over 100,000 members, qualify in the 5-star plans. Now, what is a star rating and why does it matter so much? Star ratings are essentially the way that Medicare or CMS rates these plans on several different factors, from customer satisfaction, including like customer complaints getting called in, as well as drug utilization for high-risk medications, readmittance rates in the hospitals, things along those lines. And so it's an overall satisfaction on, are you doing a good job? Now, what does Medicare do to incentivize high star ratings? They throw money at it. So if you've got a higher star rating, if you're a 5-star rated plan, you get 2 benefits. You get paid more per member, and people are able to enroll in those plans throughout the entire year, as opposed to being locked in between the enrollment periods. So it gives you the opportunity to capitalize on that higher payments that you're getting from Medicare by allowing people to enroll in those plans. And it gives people the benefit of being able to enroll in these plans that obviously are doing a good job. Now, once again, from 74 in 2022 to just 4 years later, only 7 qualifying seems pretty crazy to me. Now, how much do star ratings affect plans? Well, so much that Humana decided to sue HHS over it. And if we come down here in the article, I'll show you what this means. Only 25% of Humana's MA members will be in a plan of 4 stars or above next year, down from 94% this year. That's huge. What does it mean in dollar and cents? Well, they could lose $1 to $3 billion. When this news came out, Humana's stock absolutely plummeted. They also found out and they cut a whole bunch of benefits, or cut a whole bunch of plans, that we're not actually going to offer plans in those areas. That's where those 400,000 people went to. So it was a big deal for them. Overall, there were other people that sued HHS over this. But it seems like Elevance made out pretty well. And there were other things that they saw, and they saw them sooner. And I'm going to jump back in my time machine back to the middle of the annual enrollment period, when the news came out that Anthem, or Elevance, decided that they're cutting a whole bunch of commissions to their plans. They're cutting those down, and they're no longer going to be commissionable. And why do they do that? Well, these plans are, why are you cutting plans? Essentially, what you're doing when you cut these plans is you are cutting sales, okay? And it says it right here, stopping commission payments means that you're stopping sales. Not only did they stop commissions, but they also cut backs on ways that you can enroll in these plans, no longer allowing electronic enrollments. People could still enroll, but they would have to do it with paper. And so that was some of the reasoning behind that. Jump back over here to this and why they're pulling back on marketing. If I come on down here, I think some of the story gets told. It's often a temporary decision to give the MAO, or Medicare Advantage organization, a year to catch up and right-size the impacts of the prior year. For example, it might be in response to larger than expected enrollment during the prior year, or higher utilization. Both of those things were mentioned previously in this call, or in this video. And so I think that is a big part of it. So they're cutting back on it, but they're not cutting back on all enrollments, because they've decided, if I come on down here, it is noteworthy that they're still going to allow special needs dual eligible plans to have commissions and be enrollable. Well, the NABPI or BIP is doing a little bit of pushback, and they came out and they said, hey, with the recent decision to withdraw plans from digital agent accessible platforms, Sunfire, Connecture, we think that that is going to remove the process for people to be able to make informed decisions and eliminate the ability for seniors to rely on making these changes. So they are getting pushback from some of our industry standard bearers here, but there's not much that we can do about it. Now, all that being said, we did have recent news that there is increased funding to Medicare Advantage plans coming up in 2026. It was the largest one that we've seen, almost 10% year over year. Great news on that side of things. Like we read back in this article, it's typically a temporary thing to right size. So what I think this is, Elevance is not going to allow commissions throughout the course of this year, but I wouldn't be surprised if they bring them back during AEP next year. And so I think even if you are not contracted with Elevance or you are contracted with Elevance, I wouldn't drop my contract. If you're not contracted, even though you may not be able to make commissions off of them this year, I think it's a smart idea to get contracted now, just in case they have another great year and they're paying commissions. If they choose not to pay commissions, well, then you can do with that what you want. But remember, there are blackout periods. There are times a year when you're not able to switch your contracts or make or enroll in a new contract. So it's definitely something you want to look at now during this time of year. Elevance is still a great company. Anthem has a wonderful name. They're clearly growing. They're coming up in this space. I think it's something that we all need to look at. And hey, if you don't have a contract, it's something that you should look at picking up, even though you can't offer them this time. But hey, get it out of the way now. All right, just wanted to share that with everybody. Hope you all have a great day, and I'll be back again soon.